Let us see some of the other factors which are relevant in case of a home loan. Let me just write home loan over here. The first one is rates of loan. So normally in case of floating interest rate loans, the rate of interest is 7 to 12%, which has been in there in India for the last 4-5 years. It varies between those two numbers, more towards 12, less towards 7. Okay. India has seen a rising rates of interest for the last couple of years. Fixed rate interest are generally 1 to 3% higher than the floating rates. If you want to go and negotiate a fixed rate with the bank, chances are it may not do so. Okay. Particularly now, they can do it actually. The reason being that today the rates of interest in any case are very high. So if you go and tell the bank, okay, I'm ready to pay you 15% per annum for the next 20 years, they'll be more than happy to take it. But normally there's a difference of 1 to 3% between the fixed and the floating rate of interest. Then there's a concept of insurance of home loan. What you can also do in case of home loans is that you can insure the home loans so that in case something happens to the borrower tomorrow, the family is not asked to leave the house. This is very important. So in this case, what happens basically is, so let's say A took a loan from the bank called B. Okay. So through this home loan insurance, what will happen is the bank is going to insure the life of the person on whose basis this loan has been given. Okay. And there are various things which are covered in the house loan also, the insurance part basically. Tomorrow if something goes wrong to this person, then the insurance company, which might happen to be some kind of a related company to B only, is going to give that insured amount to A's family. Okay, and A's family can then pay that money to clear off the loan which they had taken from bank B. Okay, so the purpose of insurance is that just in order to ensure that the money which the bank has given is recovered, one, and second, the family of the person who's taking the loan is secured so that if anything goes wrong to him, the family is able to get back the house. Right? So housing companies also insure your home loans, of course through their related companies, because there are a different set of regulations which are applicable. Many banks are willing to provide additional loan to cover up the insurance amount. So let's say you buy a property of 10 lakh. If suppose the insurance is 20,000, I'm sure you must be joking around that you can't get anything for 10 lakh today, right? So if the insurance amount is 20,000, what the bank will do is they will give you a additional loan of 20,000 to cover the premium for this insurance. And this 20,000 again you can pay by means of additional EMIs, right?